on the most recent writings in the Globe and other periodicals regarding the insurance rates that have increased both in the personal and commercial insurance world. And if anybody saw the Globe article on Sunday, it really talked about the commissioner and how he felt he was alone in approving certain rate increases. What the consumers, Jeff, really don't understand is that the rates are based on losses, and the insurance companies have to go to the Division of Insurance to get their rates approved statistically. In other words, they can't just ask for $1 million rate increase and get it approved. The disconnect for many consumers are seeing these national companies paying CEOs very, very large bonuses in the $1 million range, millions of dollars. And they don't see why they should have an increased rate if the CEO is still being paid his performance bonus.
Okay.
So the challenge in the industry is really to educate the consumer to understand that in good times when the insurance companies make money on their investments, they don't need as much rate increase. But when investments are down and we have three major weather-related issues, they have to expect some rate increase to make sure these companies stay in business.
So, and just talking, I'm sorry to interrupt, you said about making money on the insurance agency. So in a low interest rate environment right now where, you know, we see the insurance companies with their set dividend rates, or they can't achieve because we're at a 10-year treasury of like 1.43% yield, is that also affecting the insurance companies with making more money on their own dollars and forced to increase rates?
Yeah, that is a basic principle of insurance,
right,
where you pool money together and you take someone's dollar and reinvest it and hope to gain income on that.
But I don't think people really understand that mechanism of how that, because we have had clients with whole life or different kind of insurance that their rates are going up, but they really don't understand why.
And
I'm not even sure that it's fair. You know, it seems like what you're saying is that regardless of the economy, they're going to make their money. And they're going to regulate your rates because they have to make money no matter what. So let's say I'm at Mage, which I am, and John Dustin wants to hire me as his consultant, which I think would be a great thing to do. You know that already. So, but last year I was down 10%, so I'm going to up my fees to you this year 10% to overcompensate that. We're just going to rough it out together. That sounds to me what you're telling me they do. You're going to pick up the difference.
It's a little more complicated than that. On the carrier side, they have to stay profitable to stay solvent. And you have to remember, insurance is a mechanism for catastrophe.
But they're for-profit companies.
They are for-profit companies, and they watch their expenses, both underwriting and sales expenses, as well as their losses. They combine expenses and losses. So if you collect $1 and pay out $1.25 or $30, which was what happened last year, you can only do that a couple of years in a row and stay in business. What offsets those losses a lot of times is investment income. And in an aggressive investment market, they can offset that $1.25 or $30 and bring it down. That has not been the case the past few years.